Welcome to First Mover, your first global look at today's action in the Bitcoin block digital asset space. I'm your host, Christine Lee. Joining me is my co-host, Executive Director of Global Content, Emily Parker. Good morning, Emily.
Good morning, Christine.
Good to see you. All right, let's have a live look at Bitcoin right now. The CoinDesk Bitcoin price XVX index currently at 48,067. Bitcoin shooting up, making its ascent up over 7% over the past 24 hours. The CoinDesk Ether price ETX index is at 34.66. ETH also climbing ahead, almost 4%. The DFX CoinDesk DeFi index is over 300, now at 305, making gains of over 3% for the day. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. So interesting, Emily, we're seeing the markets continue to climb. Why is that? It's a big question.
So I think what's funny about this particular climb is that nobody's even really pretending to have a consensus view. You know, usually there's like some dominant narrative that prevails, like Bitcoin is rising because of this, or the market is rising because of this. But now I feel like everybody's just saying different things, or they're just like, it's because of everything. So yeah, I don't think there's one dominant narrative as for why Bitcoin is rising right now.
Well, we've been hearing about a lot of institutional adoption. And so with our next guest, we hear that Wall Street heavyweight Goldman Sachs has made headlines last week after completing their first ever crypto-related trade in partnership with digital assets firm Galaxy Digital. It's part of a wave of institutional interest and exploration into the crypto space. Joining us now to discuss is Robert Bogucki, head of derivatives at Galaxy Digital. Welcome, Robert. So tell us exactly what this crypto-related trade that Goldman Sachs conducted. It generated a lot of excitement. It was in partnership with Galaxy. Tell us what it is exactly and what its significance is.
Hi, good morning. Thank you for having me on. The significance of this trade was it is the first over-the-counter crypto option that's taken place between a U.S. bank and a crypto firm. So what Goldman Sachs did is they actually purchased an over-the-counter crypto option, an option actually on Bitcoin with us. And the reason why it's significant is it's emblematic of banks coming into what we affectionately call the fifth asset class and wanting to participate and have exposure and deliver that exposure to their clients. So it was a very significant step.
But we noticed that it's not investing in Bitcoin directly. So is this a tepid way of getting into Bitcoin? And does Goldman or other clients have other exposures in crypto that would require them to take on this trade?
Yeah, you could say that, getting into it like in a bit of a tepid way. I kind of prefer it to call it, baby steps, right? It's like, Neil Armstrong stepped on the moon. It was just one step, but it was super significant because it was the first time anybody had stepped on another celestial body. This is very similar to that, and it's very resembling of having been around the foreign exchange markets my entire career. It really resembles things like emerging markets. When certain currencies were not deliverable at first, people started to speculate in them and use them to hedge in non-deliverable format. Things like non-deliverable forwards and non-deliverable options are usually the first step for an emerging market currency to come online. And having been around crypto for almost 2 years now, I really feel like it's very much akin to an emerging market asset class. And so it's really taking all of the same steps that I've seen emerging market currencies take before they come properly online to be deliverable and to be banked.
So would you say that this step is a way to kind of protect investors to some degree from the volatility of Bitcoin?
Options, when you go long an option, obviously you're exposed to the positive side of volatility. And also drawing from my previous experience in traditional finance, anytime I ever endeavored into a different asset class, I grew up in foreign exchange, but eventually I had to run businesses in things like commodities and credit and fixed income. Doing an option is actually a great way to start out because the most basic attribute of an option is that the most you could ever really lose is your premium. So when you come in and you lay out a certain amount of defined premium to have exposure both to the volatility and the direction of something like Bitcoin, the most you're risking is that premium.
Your timing is also pretty great because we're seeing a rise in the market. So I wonder, what's your take behind what is causing the crypto markets to increase right now?
Look, that's a great question. And I think what you're seeing right now with all of the things going on planet Earth, whether it's the Fed being in motion in terms of their policy changing, which we haven't seen in a really long time, to address things like inflation. And of course, inflation is another way of saying, to some people at least, fiat currency debasement. When you print a lot of fiat currency, people start to think about ways in which they can hedge that. And if you look at it broad-based over the last, 100 years, people have used gold to do that. But in the last 2 to 3 years, gold hasn't necessarily really been doing its job. So I think that a lot of people and investors and people who are just managing money in general are looking for ways to hedge the money that they're managing against inflation. Then you throw in things like what are happening, over in over in Eastern Europe, rather, with the Russia-Ukraine conflict, and people are starting to want to have exposure to things away from fiat currency, and I really think that that's what's driven the last $10,000 up in Bitcoin.
So another interesting thing that's been happening is we've seen a lot of regulatory news, particularly in the United States. There's just an executive order related to cryptocurrency. What is your, and when we talk about price movements in the past, one of the apparent drivers of price movements have been regulatory action. So what is your view right now of the regulatory outlook in the U.S.? Are you bullish on that, bearish? How do you see things going?
Look, I'm pretty bullish on it. I mean, in my prior careers, I spent time on the Federal Reserve Foreign Exchange Committee. I served 5 years on that committee. I definitely am very bullish on the United States' ability to be constructive about this. One thing that I often say to clients and even people from outside of our asset class that ask questions about it is, I've never really seen anything breathe on going digital and then all of a sudden back up and go the other way. Finance and the transmission of money for exchange of goods and services is going fully electronic. That's really just the way in which it's going to unfold. I've never seen anything, whether it's been music, whether it's been entertainment, whether it's been commerce and buying and shopping and buying goods and services online. I've never seen something breathe on going digital and then all of a sudden go back. So I think that I am pretty constructive and bullish on the U.S. regulatory approach to this. And I think it's also going to be a game of steps, baby steps and giant steps. And, I think over the next 5 years, it's going to be pretty interesting. But the U.S. being a major financial center, I think really in its heart of hearts wants to be constructive about this.
Robert, you mentioned that there are entities who want exposure to not fiat necessarily, but want to open exposure to crypto. And I wonder, we've heard from the Luna Foundation Guard is believed to be purchasing a goal of $10 billion worth of Bitcoin to keep in their reserves. I wonder, do you think that has a factor? How much of a factor does that have in the price of Bitcoin right now?
Yeah, it's a great question. I think it has a bigger factor than people want to be tempted to believe. When you look at the market cap of Bitcoin and, let's say it's around, 800, 900, $1 trillion, what have you, it sounds like 10 billion is not really a lot. But just like almost the share certificates in a publicly listed equity, the operative question is, what's the float? How many of the shares are floating around out there? And you can look at like what's on chain and what's in cold wallets in Bitcoin. And some people will come up with estimates that the float in Bitcoin might be 25 or 30% of the total supply. I think it's actually considerably smaller than that because not all of it's moving. And just because it's not in a cold wallet doesn't mean it's moving around in the exchanges. So if the float of Bitcoin is 10 to 15% of the market cap, call it 100 to 150 billion, incoming money of 10 billion is going to significantly affect it. So to answer your question directly, yes, I think that has had an effect on the upward price as well.
Well, earlier this year, CoinDesk reported that Goldman was offering clients access to an Ether fund issued by Galaxy. How is that going, first of all, and is a Luna fund in the works?
Not really sure if a Luna fund's in the works at the moment. Can't really comment on that. But in Ether, yes, our asset management division has provided funds to access Bitcoin and access Ethereum in a way that the clients don't actually really have to touch it and cold storage it themselves, and they can just get exposure to the upside in it. And so whether it's asset management in our funds or the first over-the-counter bank-traded current Bitcoin option like we were talking about just earlier, I think what you're really seeing as the common theme here is people want exposure to this, and they're trying to figure out how they can get exposure to it in the most practical way possible. And what we do here at Galaxy Digital, both through our asset management and through our markets division, is having spent time in traditional finance, like many of us have, we want to deliver this fifth asset class to the banks and to the clients in traditional finance in the exact same way that they experience the other four asset classes. We don't want people to have to completely retool in order to get exposure to this. And so all of these things, I think, are examples of a deep desire in traditional finance to have exposure to this fifth asset class.
Just to follow up on that, so you have a great bird's eye view into sort of what institutional investors are looking for. We know that obviously Bitcoin is a big thing. There's clearly a lot of institutional investment in Ether as well. Have you seen any other trends emerging? Like, do you see institutional investors looking towards any other specific digital asset or DeFi? I'm just curious if there's any trends that you're noticing that maybe people might not be as aware of.
Yeah, most definitely. I mean, last summer, there was a huge trend of traditional finance in particular, putting money directly into things like Solana, which is an alternative to Ethereum and a competitor, if you will. We're seeing a lot of interest in things like Avalanche. Avalanche just had their conference last week. We've seen a lot of institutions come in and look at that in particular. Luna as well. And then you've got the ones that have, been out there since the beginning, whether it's, Polkadot, Chainlink, and as people start to realize that things like NFTs and smart contracts, and they start to realize how important those are going to be in the new blockchain world that we're heading towards, you're definitely seeing traditional finance almost take like a venture capital approach in trying to figure out what that next altcoin is that's going to, be the next best invented mousetrap, if you will. So yeah, beyond Bitcoin and Ethereum, certainly there's like 5 or 6 that we see very steady interest in from traditional finance.
Well, I think there's a lot of interest in how Goldman Sachs is getting into the business. We reported last year that they reopened their crypto trading desk after a 3-year hiatus. I wonder if you have any insights into where their business is headed, if you're working on any other projects with them.
I think that, Goldman's made a very shrewd move in terms of acknowledging that this is, an asset class that their clients are going to want to be able to access and get exposure to. And I think in partnering with us at Galaxy, they have, sought out a way, and they found it, to access this asset class and provide it to their clients in a way that is both regulatory friendly and actually gives that exposure without, really having too much slippage to their clients as they're demanding it. I mean, when you're in these markets businesses, you have to deliver what the clients want. And I think that this is, coming just as much
and do you see that
out
as
of an interest from their
Galaxy's role
clients
in helping institutions like Goldman continue, and other banks as well, in continuing to foster that exploration to the crypto space?
Yes. I mean, we've had tons of inquiries from other banks, both before this Goldman trade and after the Goldman trade. So, yes, unequivocally.
All right, Robert, we're looking forward to those announcements. All right, we'll leave it there. Thanks for joining us. That was Robert Bogucki, Managing Director at Galaxy Digital. Coming up, Crypto Markets Update with crypto asset manager Arca. Checking in on Bitcoin, the CoinDesk Bitcoin price XVX index is at 48,067, climbing over 7% over the past 24 hours. The CoinDesk Ether price ETX index is at 3470, also making gains about 3.5%. The DFX CoinDesk DeFi index inching ever upward, 306, an advance of about 3.5% for the day. The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Joining us now to discuss the crypto markets is Jeff Dorman, Chief Operating Officer at Arca. Welcome, Jeff.
Hi, how are you?
Good to see you. All right, well, let's just start with the most obvious question. What is going on? Market's up, and, we were discussing earlier, usually there's some sort of dominant narrative. This time, everyone's just like, yeah, it's just all the things, So I'm just curious what your take is. I mean, is there, what do you see behind this rise, or is it just like nobody really knows? It's just a lot of things coming to a head.
Sure. I mean, sometimes it's less about what's driving it higher and more about what is no longer driving it lower. I think if you look at, in general, markets hate uncertainty, and what has driven the markets down, this is not just digital assets, but into equities and other risk assets as well. It's really been three things, right? One has been rising rates. It's been an absolute bloodbath for bondholders this year. This is the worst performance in 40 plus years for the bond market. Two has been geopolitical tensions, certainly led by the Russian-Ukraine situation, but also, all the spillover effects from the rise in oil to trade sanctions and what China is going to do next. And then third has been a looming recession. And really, number three hasn't happened yet, right? That's just what everyone's expecting to happen because of one and two. But both one and two, rising rates and geopolitical tensions, are starting to no longer be a factor, right? We now have a path forward to where rising rates are. The Fed finally started to raise rates. We have a pretty clear path into what they're going to do for the rest of this year. In terms of Russia, Ukraine, that's starting to de-escalate slowly. So when you remove some of those overhangs, you go back to, well, what are we sitting on here? We're sitting on, massively negative real rates. The bond market is basically uninvestable right now. Half of Europe and Asia is uninvestable right now. So where is money going to go to? It's not going to sit in cash forever. It's going to go into, safer places, which is U.S. equities and real estate, and also, maybe ironically for some, but that's digital assets. So when you start to see inflows and you start to remove some of those negative overhangs, you start to look at the places that have either positive catalysts or are somewhat recession-proof. And I would argue for Bitcoin specifically, we've seen a massive, massive positive catalyst in the last 8 weeks. When you combine what Canada did to its own citizens in terms of shutting off access to banks and brokerages, to what Russia did, basically unilaterally destroying their own economy and their currency for this war, to what the U.S. and Europe did with sanctions through the SWIFT network, I think people are starting to wake up to the fact that we used to think assets were ours, right? Money was ours. Now we're starting to realize, actually, that's not true. My money is not mine. My money is a liability from some government or some bank or brokerage account. And whether or not they actually let me access my own money is now in question. And that's a massive tailwind for Bitcoin and other digital assets. And I think that's starting to play out over the last 6 to 8 weeks.
Jeff, I just wonder if we could maybe frame a slightly different way, because the three things that you mentioned, right? Rising rates, Ukraine, Russia, fear of recession, like all those three things are still very much around, in my opinion, right? I mean, rising rates, this is happening. Whether Ukraine, Russia is de-escalating, I think that's somewhat controversial. Like, I don't think that's a done deal at all, right? And there's still sort of these fears going forward. Do you think one way to look at it maybe is that maybe for the market, it's almost like the anticipation is worse than the actual thing, because there's been there was so much talk about like rising rates or just concern over what was going to happen in Ukraine, because like those risks haven't gone away, and yet the market somehow is reacting to them differently. Could you say it that way? That's sort of more how I see it.
Yeah, I mean, markets hate uncertainty more than they hate bad outcomes. Now that we know certainly where rates are headed, you can now start to plan for that, right? It's the uncertainty of what's happening that usually drives markets crazy. So yes, rising rates is still happening. Obviously, I think Citi came out yesterday thinking they're going to be 9 rate hikes this year. You're looking at 2.5% of moves over the course of the year. That's a big deal, but it's not as big. It's not really that big of a deal when you're talking about 7-8% inflation, because that means real rates are still negative. The absolute value of these rates is less important than the rate of change. And now that that rate of change is baked into the market, you start to think about, well, what does that actually mean? Well, rising rates are bad for equities, certainly because it lowers the terminal value, right? If you look at just a standard present value or discounted cash flow model, when you have rising rates in the denominator of your cash flow model, that terminal value, that end cash flow model is going to go down. But if you look at digital assets, some things like cryptocurrencies like Bitcoin have no intrinsic value, have no cash flow, so rates don't really matter at all. Others are really more like a perpetual annuity than they really are a terminal value cash flow, which means, again, rising rates in your models, if you do a DCF, you don't really have a terminal value, so rising rates shouldn't matter. We wrote an article last week talking about, are digital assets actually recession-proof? I think they are, right? If you think about debt as your claim on assets, and you think about equity as your claim on cash flows, and you think about digital assets as your claim on network effects and customer loyalty, that third one doesn't go away if you have a recession or you have rising rates. That doesn't affect your brand loyalty. It's almost akin to a gift card, right? If I invest in Target, my Target stock will go down if the revenues and cash flows of the business go down. But if I have a $100 gift card in Target, my value of that gift card doesn't go down. In fact, it might even go up because it's something that I can hold on to and use whenever I want. The utility value of that gift card doesn't change. My brand loyalty to Target doesn't change. In some ways, that's what's happening with digital assets. So yes, we still have rising rates. Yes, we still have geopolitical tension, but it's more certain than it was. And when you actually look at the absolute value of rates, they're still incredibly low. And when you actually look at the history of what happens in both a rising rate environment and a war environment, what happened in the last 4 months is unprecedented, right? If you look at the rising rates from 2016 to 2018, both equities and digital assets did great. If you look at the rising rates from 2006 to 2008, digital assets weren't around, but equities did great. It's usually the end of a rate hike cycle when you start to have a recession and when you start to have lower prices in risk assets. What happened in the last 4 months was the market decided, hey, we're going to front run 3 years of losses in a potential recession in 3 months. And that's just not rational. You don't just go down for 3 straight years because of a looming recession. We just came off the highest fourth quarter GDP of the last decade and the best corporate earnings ever. We're not even close to a recession yet. The market is just front running what could happen. And I think, like I said, once that is baked into the market, which it now fully is, the uncertainty is gone. It's just a matter of where are we? And where we are is we still have record corporate earnings. We still have incredibly negative real rates. There's just nowhere else to put your money except for places like digital assets and equities and real estate.
Wow, fascinating when you put it that way. The market is front running what may happen. I want to zone in on a particular cryptocurrency that we've been eyeing, Terra's Luna tokens. They touched an all-time high earlier today, $106, according to CoinDesk 20 data. It's risen over 86,000% over the past 2 years, making it one of the best performing tokens out there, 8th overall of overall tokens out there, has a market cap of $37 billion. So in your view, what is behind this recent surge?
Sure. So I heard you earlier talking about, the whole crypto market is up. And I always laugh when I hear that because it's like saying the whole ETF market is up, right? ETFs themselves are just a package, and what's inside the package is what matters, right? And the same thing is now true of digital assets, right? Even though on a day-to-day basis, there's some high correlations, over longer periods of time, there's massive dispersion, right? DeFi has been down for 12 months. Layer 1 protocols have been up. Gaming and NFTs have been up. Bitcoin has been flat. You look at that dispersion, and the same thing is true in digital assets. So, what's driving Terra Luna is completely different than what's driving something like Ethereum or Bitcoin or DeFi or NFTs. For us, we look for pure plays. How do you identify an investment theme and how do you play that? So one of the most undeniable positive themes in digital assets has been the rise of stablecoins. Stablecoins have gone from $0 of assets to almost 200 billion in the last 2.5 years. And there's 3 different types of stablecoins. You have your centralized stablecoins like Tether and USDC. You have your debt-backed stablecoins like MakerDAO's DAI. And you have your algorithmic stablecoins like Terra Luna's UST. And of those 3, algorithmic stablecoins as a percentage of all stablecoins has been rising for the last 6 to 12 months, led by the growth of UST, which now has 16 billion outstanding. So if you're looking for a pure play way to invest in the growth of stablecoins, there's not that many ways to do it, right? It's very hard to invest in Bitfinex equity, which owns Tether. It's very hard to invest in Circle equity, which owns USDC. But it's very easy to invest in the Luna token, which is the backer of UST. So as a pure play, it makes all the sense in the world. And also from a fundamental standpoint, the way the Luna token is designed is for every $1 of UST that is created, $1 worth of Luna is burned or basically bought back. So effectively, you have Luna is an amortizing token that works positively as the growth of UST happens. So it's a very simple investment. It doesn't necessarily mean it's going to work, but it's a very simple investment for investors. It's, do I believe in stablecoins? And is UST a leader in stablecoins? And is UST growing? And if that is true, Luna is going higher. And that's what we've seen.
Do you think that is sustainable?
I am a believer in the growth of stablecoins. I'm a believer in the UST model. And I think, like everything in digital assets, there's a little bit of a fake it till you make it element. And once you make it, it becomes much more sustainable. I think what Terra Luna has done is they've created a algorithmic stablecoin that works. Now that it's worked so well, they're coming up with other ways to ensure that it keeps its peg and it keeps growing. That's why they're now using some of the money that they have on their balance sheet to go out there and buy Bitcoin to add additional backing to the UST peg. So, as you see creative leaders like Do Kwon, Terra Luna, and others start to say, okay, we've got past phase one, which is adoption. Now we have to get to phase two, which is continued strength and confidence in the market. I think you could argue that Terra Luna, as much as any project in the market, has done exactly what they set out to do and has stuck to a pretty smart plan in terms of both adoption and confidence in the market. So yeah, we're bullish on Luna. We own it at Arca. We think, our model says that if you believe that UST is going to grow to 30 to 50 billion AUM, which is, in our minds, pretty reasonable assumption, just pure math in terms of the buyback and burn of Luna gets you to about $400 per Luna. Currently trading at 106, there's a lot of upside. Now, as always, there's risk in those models. But again, as a pure play bet on the growth of UST, it's a pretty simple formula.
All right, Jeff. Thanks for your analysis. Appreciate you coming on the show. That was Arca COO Jeff Dorman. All right, coming up, we'll check in with Canadian miner Bitfarms and CoinDesk Global Policy and Regulation Managing Editor Nick Day. Hi, I'm Christine Lee.
Zach Seward.
I'm Michael Casey.
I'm Christy Harkin.
I'm Isaiah Jackson.
I'm Serena Lynn.
Hey, this is Will Foxley.
I'm Teresa Santos.
Hi, I'm Lawrence Lewitton.
Hi, I'm Dorian Wayne.
I'm Nicholas Day.
Hi, I'm Kevin Worth.
I'm Jordan Muthra.
Hi, I'm Brad Count.
I'm Pete Paschal.
Hi, I'm Jen Sanasi. You're watching.
And you're watching.
And you're watching CoinDesk TV.
Joining us now to discuss the regulatory environment is Global Policy and Regulation Managing Editor Nick Day. What's up, Nick?
Hey, good morning.
So, Nick, it looks like the U.S. is inching one step closer to the creation of a digital dollar, maybe. What's going on?
Yeah, so yesterday, Representatives Stephen Lynch, Ayanna Pressley, Rashida Tlaib, and Trey Garcia introduced a new bill to try and create a digital dollar. The Electronics Cash and Secure Hardware Act, basically eCash. But what's really interesting is that, unlike a lot of the other digital dollar proposals we've seen, there's no centralized ledger, there's no decentralized ledger, there's really no ledger at all in the development of this project. So the lawmakers are hoping to create a bill, create a form of digital dollar that is basically a pure electronic analog to physical cash. So you'd store it on your phone or on a smart card. You could transfer it peer-to-peer. You could do whatever you can do with cash, but there's no one keeping track of the transactions. There's no one monitoring with straight KYC beyond what you might find at a bank or a store if you're trying to buy a prepaid debit card, for example. So it seems like a pretty strong effort to try and just, as I said, create a pure analog to a physical U.S. dollar.
Interesting. I also saw that President Joe Biden has released a budget proposal with an estimated additional $11 billion in revenues by 2032 by updating crypto rules. Anything you can add to tell us about that?
Yeah, so this is just modernizing tax regulations around cryptocurrencies. And we saw something similar last year even. That budget I don't think has actually been passed, but Biden's trying to close a couple foreign tax loopholes for cryptocurrencies in particular. We're seeing greater amount of attention paid to this. It seems fairly standard. What was really interesting to me is that the Biden proposal also, included increases for the SEC Division of Enforcement. Didn't specifically mention crypto, but if you're in crypto and you've heard of the SEC, you have to imagine some of that funding might go toward increasing his investigations, increasing the enforcement actions. There's also a proposed boost for Financial Crimes Enforcement Network, so FinCEN, which we've talked about before. FinCEN has been given certain mandates around crypto and has not been given the commensurate budget to address these needs. So the proposed increase might help it do so, should that become a reality.
All right, Nick, thanks for the update. That was CoinDesk Managing Editor of Global Policy and Regulation, Nick Day. Don't forget sign up for his newsletter, The State of Crypto, on CoinDesk.com.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
Climate change activists, including Greenpeace and Ripple co-founder Chris Larsen, are launching a campaign to convince the Bitcoin community to change the source code and mining more environmentally friendly. Something tells me this isn't going to go over very well. Joining us now with more is Ben Gagnon, Chief Mining Officer at Bitfarms. Hi, Ben. Thanks for joining us. So Chris Larsen has been talking for years, $5 million into this change the code campaign to convince miners to move away from proof of work, which uses a lot of energy to verify transactions in the blockchain. Can you be convinced?
We've heard these claims for many, many years from a lot of different groups on the environmental sides of Bitcoin mining and what Bitcoin mining's impact on the environment is. But, a lot of this is really, really shady science. There's not a whole lot of data that supports this, and it really ignores a lot of examples like Bitfarms, who are very publicly and very transparently mining Bitcoin on huge amounts of hydro and renewable resources in places like Canada, the United States, and Paraguay. So since our inception in 2017, we've mined somewhere around 15,000 Bitcoins with hydroelectricity, and these sorts of claims are completely ignored. I don't think that this is going to go anywhere. It seems like another play by Ripple to promote their own token at the expense of Bitcoin using shoddy science.
So what are the odds of the Bitcoin community signing on to this, and what could possibly go wrong?
I think the odds are zero. Nobody who's a Bitcoin miner is going to want to sign on to a policy like this. Proof of work is one of the most important inventions that mankind's had in the last 100 years. I mean, this is an ability for people to monetize energy anywhere around the world, create jobs and create value in remote, overlooked, and distressed locations. This is something that's not going away, and is very, very important. I think a lot of this comes down to this idea that, what we're doing as Bitcoin miners is simply processing transactions, and that's just one part of what we do. The other part of what we do is we keep everybody's Bitcoins who are not being transacted safe. And when you have that kind of false equivalency of saying, this is the consumption of electricity for a transaction, you're not getting anything meaningful out of that, because it's not just what Bitcoin mining is doing. We're also keeping everybody's Bitcoins around the world safe every single block.
So, in the United States, at least, science has never been able to end an argument one way or another, right? Because, nobody agrees on anything, it seems. And I guess, so the question is like, your perspective that this sort of environmental damage argument is overblown, like, how do you win that argument, though? Like, how do you convince more people of that? Because it also seems that the more mainstream investors coming into the market, they Google Bitcoin, this is one of the first things that comes up, right? This is still a very, very mainstream perception that, Bitcoin mining is very detrimental to the environment. So, like, how do you win that narrative?
Yeah, well, I think we need to win it with the data, because the data is pretty clear on this. I mean, there's been articles back as far as, I think, 2016 and 2017 that said by 2021, Bitcoin would have already raised global temperatures 2 degrees Celsius. I mean, these are outlandish claims that are provably false. With regards to the claims that Bitcoin consumes as much power as countries, this is a really disingenuous claim because we're talking about climate change, which is a global problem, and they're comparing it anecdotally to one-off countries. What they don't admit and what they don't recognize is that the amount of electricity consumed by countries around the world is an exponential curve. And so you can easily choose a country far down the list, and it still doesn't represent a huge amount of global power consumption. The only way to directly compare Bitcoin mining and its impact on the global climate change program is in the context of the globe. And when you look at it in the context of a globe, Bitcoin's electricity consumption is somewhere between 0.1% and 0.2% of the world's electricity consumption. A very different image in your mind, seeing 10 basis points or 20 basis points as compared to an entire country. And so they do that to paint an image that the electricity consumption is far greater than it actually is. The reality is that it's a very, very insignificant amount, more comparable to something like the amount of electricity consumed by Christmas lights around the globe in a given year. And the reality is that most of the Bitcoin miners are trying to take advantage of wasted or stranded energy. I mean, wasted electricity is the number one consumer of electricity worldwide. It's 170 times greater than the Bitcoin network is right now. And that's what Bitcoin miners are primarily trying to monetize through programs like curtailment, like Bitfarms is using in Quebec, the curtailment programs in Texas, the power demand response programs. All of this is trying to tap into this unutilized and otherwise wasted electricity, which would allow the network to grow 170 times bigger than it is today without any change in global emissions.
Interesting. Well said. Bitfarms also, they're reporting sales of $60 million for the fourth quarter of 2021. That's up 33% from the third quarter and up 426% from the fourth quarter of 2020. Tell us what's behind this exponential growth you're seeing.
Yeah, I mean, we've had a tremendous year at Bitfarms last year. We more than doubled our hash rate, growing from 965 petahash to just a little over 2 exahash at the end of the year. And really, this is a strategic strategy by Bitfarms to gain a lot of market share prior to the halving that's coming up in 2024. So we signed huge contracts, we developed new infrastructure, and we're continuing to do that. This year, we're scheduled to grow about 4 times bigger than we started the year, ending at around 8 exahash at the end of the year. So massive plans rolling forward. We're developing hydroelectric resources in the United States, in Canada, in South America. We're developing all sorts of new sites, and we've got tremendous growth plans ahead.
So my understanding is that most of your mining is taking place in the US and Canada, right? And you have some other places thrown in as well. So this has been one of the biggest stories of the past year or so, is like this move of mining from Asia to North America. But it has also kind of given rise to some concerns that mining will now actually become centralized in North America. Like North America will take a disproportionate lead. Do you think there's any truth behind that?
Well, Bitcoin miners follow the electricity. And if you look at where electricity is available, the United States is the number one market after China. And it's an exponential curve down the list. And so as a miner, like I said before, we're trying to take advantage of that excess electricity. If we want the low-cost electricity, we don't want to be competing with numerous other sources of demand for it. And so we're seeking out power that generally used to fund or used to power old infrastructure back in the 20th century and has since been exported abroad to other countries or moved to a different facility somewhere else. So in Canada, we've taken over hockey stick factories and all sorts of industrial plants that were built up in the 60s and 70s and were powered with hydropower, and all these electric dams came in there to facilitate this infrastructure growth and this business growth. But over time, those industries left. This means that there's plenty of ready, available, high-quality infrastructure that Bitcoin miners can take advantage of, and that's what you primarily see happening. But we'll go all over the world. Wherever that electricity is available, is cost-effective to develop, and is predictable in the long term, you should expect to find Bitcoin miners there.
Also saw that Bitfarms mined over 1,000 Bitcoin in the fourth quarter of last year. Also in January, Bitfarms purchased another 1,000 Bitcoin. So what are you doing with all your Bitcoin holdings?
Yeah, it's a good question. What we are at Bitfarms is a pure play Bitcoin mining company. So we provide investors on both NASDAQ and the Toronto Stock Exchange for the Ventures Board pure play Bitcoin mining exposure focused on a growing Bitcoin hash rate and a growing Bitcoin hodl. And by doing that, we're giving investors basically the ability to kind of invest it directly into Bitcoin, but really more of a Bitcoin cash flow. So it's similar to investing in something like a Grayscale ETF where you have a fixed amount of Bitcoin, but that fixed amount of Bitcoin is growing every single day. We announced yesterday we're mining about 12.5 Bitcoins every day right now. So imagine that fixed amount of Bitcoin, just 12.5 Bitcoins every single day onto the balance sheet. So that should give compounded effects or a leveraged exposure to Bitcoin over time. I think that's a very important thing for investors to have because, as we talked about with decentralization before, there's more than one aspect to decentralization. Obviously, you have the decentralization of the miners themselves physically, but more importantly now, there's also this decentralization of ownership that's happening through public companies and through their public shares, so that the owners of our hash rate are spread around dozens of countries amongst thousands of investors and companies who have invested in our company and invested in those that hash rate and that Bitcoin hodl. So by doing that, we're kind of taking away the risk and we're taking away the incentive for any of us as a Bitcoin miner to do something malicious. We're all incentivized to grow the company and protect Bitcoin together. And that's what's happening, I think, right now in the United States, especially through the public miners.
Interesting. All right, Bitfarms, big time holders. Thank you for your insights. We gotta wrap it there. That was Bitfarms Chief Mining Officer, Ben Gagnon. All right, time to check in with Crypto Twitter for our tweet of the day. This one from Gabor Gerbax, founder of Pointsville app, tweeting to Cripple's Chris Larson that whole change the code campaign he's launched. I want to provide an alternative view on Bitcoin's ESG status. Bitcoin is one of the greener technologies. I believe that proof-of-work-based systems such as Bitcoin can coexist and collaborate with alternative networks and systems. Bitcoin has no unique ESG problem, followed by his research finding that 76% of miners use renewable energy sources and 39% of total Bitcoin miner energy consumption comes from renewables. That's it for First Mover. Thank you, Emily Parker. I'm your host, Christine Lee. Meantime, check out The Hash at noon Eastern and All About Bitcoin at 3 o'clock. You're watching CoinDesk TV. Also, next up, stay tuned for the daily forecast to see what's happening in the Asia crypto markets.
Could India's move to tax crypto profits and transactions have backfired? Welcome to the Daily Forecast, March 29th, 2022. I'm Megha Chadha of Forecast, covering all things blockchain. India's tax on profits from digital asset transactions goes into force from Friday. But investors aren't happy and the government could lose out as a result. We'll take a look at that story plus a whole lot more coming up. Let's get you up to speed from Asia to the world.
Join thousands of NFT traders who already start their day on CryptoSlam.
Let's kick off with more moves coming towards mainstream acceptance of cryptocurrencies. The Australian crypto exchange BTC Markets has announced it is partnering with financial services giant MasterCard for payment options. The deal will allow customers to make direct debit, prepaid or credit card payments for purchases of cryptocurrencies from the platform. The move is part of a broader trend by companies like MasterCard and Visa to incorporate cryptocurrency functionality into their services. Last year saw MasterCard partnering with another Australian crypto exchange, CoinDesk, to offer a crypto payment card. Australia's crypto sector is bracing itself for a broad regulatory sweep following a wave of proposals from politicians for the industry. Meanwhile, the United Arab Emirates, is fast becoming the next crypto hub, with 2 exchanges announcing plans to open offices in the region's trade center, Dubai. Singapore-based crypto exchange Crypto.com said it will establish a regional office in Dubai and announced it will be the exclusive crypto exchange partner for the government-backed Investopedia Summit. Meanwhile, Bybit, which is also based in Singapore, said it has received an in-principle approval to conduct crypto business in the UAE and that it will move its global headquarters to Dubai, with operations to begin as early as next month. These are just the latest moves in the UAE's drive to become a center for the virtual assets sector. Earlier this month, 2 other major crypto exchanges, FTX and Binance, acquired crypto licenses in Dubai. And Dubai, which is one of the 7 members of the UAE, recently adopted its first virtual assets law to create a legal framework for businesses and investors. You can find those stories and a whole lot more at forecast.news. Over in India, the government's attempt to profit from digital asset gains could be backfiring, with new investors being put off and existing investors seeking to make an exit. Forecast Pradipta Mukherjee reports from Kolkata, India.
India's down-on-its-luck government is seeking its pound of flesh from the gains made by investors in digital assets. A 30% tax on all profits made by trading virtual digital and crypto assets starts this Friday, while a 1% tax taken at source on all crypto transactions begins July 1st. Not only that, even the legal status of the asset class hangs in limbo, with the Reserve Bank of India repeatedly cautioning against crypto. India has one of the youngest populations in the world, and while digital assets have proved very attractive to younger people and first-time investors, these new taxes could really hit those hardest who fall into the lowest income tax brackets. All this has left these younger investors reconsidering their options. Indeed, even some of the keenest followers are adapting their portfolios, like 24-year-old Neil Kukreti, who posts crypto educational videos on his YouTube channel.
I will be reducing my crypto exposure by 30% till then, and I will be taking out all the fiat currency that I have lying around in various exchanges so that I can reinvest it later after April and reduce my tax exposure. So overall, the total value I have invested in crypto will be decreased due to it not being as favorable to invest in.
And one expert told Forecast, it's no surprise younger investors are getting out.
The brave young people who approach this world of cryptocurrencies would rather go to other segments of investments like stocks or commodities, where the laws and the tax laws in particular are less draconian. What the government has done is to make cryptocurrency trading a bit like an uninsured home or car, where if you suffer a loss, it's gone for good.
Experts say India would have been better off starting with a lower rate of taxation for this still nascent investment class to help address the rising fiscal deficit in the country. India's fiscal deficit, which is the difference between total revenue and total expenditure by the government, is projected at 6.9% for the fiscal year which ends this month, which is higher than previously estimated. For Forecast, I am Pradipta Mukherjee, Kolkata, India.
NFTs started life as digital collectibles, but as they go mainstream, dozens of new use cases are being explored. And this includes using that NFT sitting in your digital wallet as collateral to borrow money. Benjamin Stanley, Business Development and Sales Director at Matrixport, a crypto financial services company serving both institutional and individual investors, joins in to talk about just that. Great to have you with us, Benjamin.
Thank you very much.
Benjamin, now so far, people have largely looked at NFTs as a means of collecting digital art, but the underlying tech has a lot of potential for developing financial products in the DeFi space. What do you think?
Yes, you're absolutely right. NFTs are so much more than just expensive JPEGs that you can collect. A lot of them have turned out to be entry tickets to virtual communities or can become part of your digital identity. They can be in-game assets or have a functionality in the metaverse. So the point here is a lot of them also have utility. And so naturally there's people who want to use this utility. There's people who want to invest in this utility, and there's people who want to build on top of it. We at Matrixport, we're at the forefront of that, and we just published a report about the financialization of NFTs, to what you alluded to before. We include information about rental, fractionization, and other derivatives that are built on top of that.
Well, there are dozens of platforms like Arcade and NFT5, besides numerous others, where one can borrow money using NFTs as collateral. Now, they've seen tremendous growth despite charging eye-watering levels of interest, which can run into 50 to 60% in extreme cases. What's driving this growth?
We're right now witnessing the financialization of NFTs. And by nature, these tokens are non-fungible, which primarily impacts liquidity and therefore makes them, in general, less suitable as collateral than, let's say, fungible tokens. However, using non-fungible assets as collateral is actually not something new. If we look at our physical world, for example, a house or a flat is a unique asset, so it's non-fungible. But of course, you can borrow against it. So the question is, why not against an NFT? Especially if it's a high value NFT that belongs to a collection where you have an active liquid market in it. You could take the floor price, for example, look at the attributes of the NFT and how rare they are in the collection, and then determine the price. That is similar how you would look at the real estate price by determining the price in an area, and then look at how your house is worth, despite the house actually not being traded. So we are also planning to accept high profile NFTs as collateral soon. I stress here high profile because I do believe that there's a long tail of NFTs that are probably not even worth the gas that has been used to mint them.
And finally, what would you say are the main risks for those lending against tokenized assets? Given the lack of regulation and oversight by centralized agencies, is there an increased chance of scams and digital thefts?
I think the risk is actually twofold, yeah. So the first one with NFT lending as collateral is actually the same risk that you would have when you do collateralized lending with other assets. It's the risk that the asset itself loses value and the loan can't be recuperated. This can happen by overestimating liquidity or poor risk pricing. And again, in our physical world, that's not something that's unusual. Let's take the 2008 subprime mortgage crisis in the US, for example. That might be an example. The other angle, however, is more unique to digital assets. A malicious actor can abuse a smart contract loophole, or they can just simply hack your wallet and transfer the NFTs out. And because how young our industry is, there isn't much of a legal oversight or actually law enforcement to such acts. To be quite frank, it's not even clear that all of these acts are actually representing a violation. But of course, you want to protect yourself. So how do you do that? Well, a good way of mitigating this risk is using cold storage and a trusted custodian. And safeguarding our assets, I think, is something that should be highest of your priority, especially in crypto and digital assets for the long run.
All very valid points right there, Benjamin. And we are just at the inception point of understanding the potential of NFTs. Thank you so much for joining us today with all the insights, Benjamin.
Thank you for your time.
And that's the Daily Forecast, bringing you what you need to know about the blockchain world from our vantage point right here in Asia. For more, visit forecast.news. I'm Megha Chadha. Until next time.